Hello and welcome to this session in which we will discuss non-financial measures. Non-financial measures are matrices that are not based in monetary unit. Monetary means dollar amount. Whatever currency we are using, I'm using the dollar amount. But rather another quantifiable, somehow we can measure them, aspect of performance, but not through money. These measures are used to track efficiency, effectiveness, quality, and success of an organization in various areas that do not directly pertain to financial matrices. Like what? What are financial matrices? Revenues, profit, return on investment, gross profit percentage, return on equity, so on and so forth. So why are these non-financial measures important? The assumption is this: if you are being efficient, effective, have good quality, you have a good processes, good management, eventually that will translate into good financial numbers like revenue, profit, return on investment, so on and so forth. So that's the idea behind studying or learning about or measuring and monitoring the non-financial measures for a company. So in this session, we're going to look at various non-financial measures. We're going to see how we compute some of them. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Let's start with a series of examples, just about non-financial measures, series of examples, starting with customer satisfaction. Customer satisfaction is gauging customer satisfaction through survey, feedbacks, and rating. Why is that important? The assumption is if your customers are happy, they are repeated customers. And if they are repeated customers, you generate more revenue. If they are happy, they're not only repeated customers, they may tell other people about your product. Therefore, you want to increase your customer satisfaction, but you want to measure this. It's a non-financial measure that will lead to financial success. Quality of your product, measuring the quality of the product or service through return rates, defects, compliance with standards. You want to measure those. Although they're not directly financial measures, but if you have a high return rate, you want to investigate why, and maybe you want to reduce this. If you have a lot of defect, the same concept. Good quality would eventually lead to revenue, additional revenue. Efficiency. How long it's taken you to produce something. What is the waste percentage? Resource usage rate. If you are efficient, your cost goes down. If your cost goes down, your profit goes up. You are measuring non-financial measures that could lead to financial success. Innovation. Track the rate of new product development, patent filings, percentage of revenue from new product. If you have new product, innovative product, what is that going to translate into? More revenues, more successes. Employee performance. You want to know how well your employees are doing, how often do you recruit, what is the employee turnover rate. It means when they leave you, and we're going to measure this. We're going to see how we can measure this. So using performance review, training levels, or engagement scores to keep the employee happy, train them. Why? Because happy employees would produce good product, good services, which in result do what? Provide more revenue. You guys get the point now, right? The importance of non-financial measures. Brand recognition, assessing brand strength through market survey and social media mentions, because the more you are known, the more likely the people to purchase from you. Sustainability. Well, matrices related to environmental impact like carbon footprint, energy consumption, or recycling rate. That will also lead to more brand recognition, which would lead to maybe to innovation, which would lead more to customer satisfaction. People are happy, which would lead to more revenue. At the end of the day, the goal is to increase revenue, increase cash flow. Safety. Workplace safety statistics, such as the number of accidents or near misses. And this is going to affect employee performance, employee morale, As a result, it's going to affect the quality of the product, the quality of the service. As a result, it's going to affect revenue. We are going to go through some specific computation to specifically measure those non-financial measures, starting with employee turnover rate. What is that? It's a matrix that measures the rate at which employee leave the organization and be replaced by new employee. Now, let me ask you this. Do you want to have as a company high employee turnover? And the answer, absolutely not. There's a cost to hire to recruit, to hire, to train an employee. And if the employees keep on leaving the company, that's not good for us. So it's critical for HR to kind of monitor this rate, because if people are leaving a month or two after they are hired, is human resources not doing a good job? Or is there something wrong with the workplace environment? So that we are recruiting the right people, but the workplace environment is really demoralizing, and people don't want to stay with us. They are not satisfied. Well, we need to know about this. We need to know about all of this. So let's take a look at how we compute this. First, you determine the period in which you are performing the computation. Let's assume we're going for a year. We can do it quarterly, but a year is better. Count the number of separation, people that leave. Count the number of employees who left the company during that period, regardless of the reason. Calculate the average number of employees. Find the average number of employees during the period by adding the number of employees at the beginning plus the end and divide by 2. This is how to find the average. Then we're going to use this formula here to compute employee turnover, which is the number of separation. The number of separation is number 2. Dividing number 2 by number 3, the average of number of employees. Let's work an example to put figures on this. So at the start of XYZ company had 100 employees to start with. Over the years, we had 15 employees, 15 separation that left the company. By the end of the year, we had 110 employees after we replaced the people that left. So here's how we compute this. First, we compute the average number of employees. The average number of employees at the beginning of the year was 100. At the end of the year was 110. That's divided by 2 equal to 105. Then, to compute the employee turnover, we'll take how many separation we had, divided it by the average number of employees, multiply by 100 to find the rate. And we find the rate happens to be 14.29. Now, always ratios, figures like this, they don't make any sense unless you put them into perspective. But what does that mean? This means that over the year, we replaced about 14% of the workforce. Is this good? Is this bad? Well, we can compare this rate to prior years. So if in prior years the rate was 25%, we were replacing more, then we are improving. And if the prior year was 10%, then we are deteriorating. The percentage helped the company, XYZ company, understand its workforce stability and its effectiveness of its retention strategy. How well am I keeping the employees engaged, trained, happy? They want to stay with me. Because this is going to give me more insights about job satisfaction. What's the assumption here? High turnover might indicate low job satisfaction. Am I hiring the right people? Am I putting them in the right job? Am I properly training them, supervising them, giving them the proper resources to do their job? Cost. Well, it can be costly to recruit and train new employees, so a high turnover might signal higher operational cost. Well, I need to be aware of this. Therefore, I need to have a better recruitment policy. Employee engagement. Low turnover might suggest, if it's a low turnover, that employees are engaged and committed to the organization. High turnover, it's the opposite. They're not happy. They don't want to stay. Management effectiveness. Turnover rates can reflect on management ability to retain talent, how well management is doing their job in keeping those employees. Because once you hire an employee work under a manager. How well is that manager managing this new employee, keeping them motivated, engaged, so they can stay? Another measurement we could look at is customer retention rate. Now, rather than keeping employees, remember, good employees will help you produce good product, but also customer retention. How much of our customers we are keeping from period to period. So this is the rate to measure how well a company is keeping its customer over a period of time. Why is this important? Because the rate is crucial, because it costs less money to keep an existing customer rather than to acquire a new one. Same thing with employees. It's less money to keep rather than hire a new person. And loyal customers, if you have people who are repeating, like if you are a member of Farhat Lectures, you're a loyal customer. Often you're gonna tell other people about the product, and that's why you want to keep the customers happy. Loyal customers will increase your revenue and will help spread the word for you. Basically, it's considered word of mouth is the best type of marketing. How to compute this rate, customer retention rate? Well, we're gonna start with the number of customers at the end of the period. We're gonna call it E. Subtract the number of customers at the end of the period, call it an N, and obviously the beginning minus the end. Then divide by the number of customers at the start of the period, which is in S. Well, let's take a look at this. Multiply then by 100. So we're gonna go with what we started with, and start with the number of customers at the end of the period, subtract the number of customers acquired Let's go ahead and compute customer retention rate. We're going to start with the number of customers at the end of the period. How many customers we had at the end of the period. Then we're going to deduct the number of customers acquired. Take out what we acquired this period. Then divide by the number of customers at the start of the period. Let's take a look at the formula. Then multiply by 100 to get a percentage. So E is the number of customers at the end. Subtract the new N. And divide by S, the number of customers at the start of the period. Well, let's take a look at an example. If a company had 500 customers at the start of the year, they gained an additional 100 during the year and ended up with 450. Well, how do we compute the retention rate? E is 450 and the new customer is 100. Customer at the start of the year was 500. Insert these into the formula and we're going to get a customer retention rate of 70%. Well, we need to interpret the 70%. This means that the company retained 70% of its customer base over the year. They retained 70. Now, the higher you can retain, the better off you are. Hopefully, you can retain 100 if you can. That's the best. So, interpreting the retention rate can provide insight into customer satisfaction. How well customers are happy. Product and service quality. Because if they are happy and you have a good quality, they will stay. And how loyal they are. How are you keeping the customers loyal? So a high retention rate generally indicates that the customers are satisfied and less likely to switch to a competitor. On the other hand, a low retention rate could be a warning sign there are issues with the company's offering or services that need to be addressed to improve customer loyalty. Another non-financial measure we can compute is labor productivity rate. Labor productivity rate measures the amount of goods and services produced, output, per unit of labor over a specific period of time. It's a key indicator. Usually it's an economic indicator, but it could be used for any company. In economic performance and organization's efficiency. So labor productivity rate can result from improvement in technology, and usually that's what really improves labor productivity rate, because with technology, you can produce more with less. So with technology, your output goes up, your unit of labor, the input might stay the same or even go down. And this is what's going to happen with AI. If AI replaces jobs, the input will go up and the labor would go down. You can improve it with technology, tools, equipment, skills. If people are better trained and they are learning on the job, they become more efficient. Their output goes up. They're still giving you the same amount of hours. So determine the total output. This can be in terms of unit produced, tasks completed, the value of goods or services, usually measured over a period of time, like a quarter or a year. So what's your output? Determine the total labor input. How much labor are you inputting? This is typically measured in labor hours worked, but it can also represent by the number of workers if hours worked are consistent. Then you could compute the total productivity rate by taking total output, dividing it by total input. Again, I'm going to mention as technology improves, your output goes up, your input labor goes down, because you need less people, less labor to do the same amount of work or even do more work with technology. Let's take a look at a problem with numbers. If a factory produced goods worth $1 million in a year and the total labor input was 20,000 hours, what would be the labor productivity rate? Well, we produced $1 million worth of goods, we inputted 20,000 hours, the labor productivity rate is $50 per hour. This figure means that for every hour of work, the factory produced goods worth of $50. Now, improving labor productivity rate could lead to higher wages, lower production cost, more competitive pricing, and increased profitability. Why? Because as employees are doing better, you're gonna reward them, otherwise they would leave. Also, as they are doing better, your production cost goes down, and that's why you want to reward them. You're gonna have more competitive pricing. It's costing you less to do the same thing. Therefore, you can lower your cost, and as a result, overall increase profitability. This rate also allow a country or a company to generate more output without increasing the amount of labor, which is beneficial for economic growth and development. So labor productivity rate, just to kind of give you an idea, because this is also kind of an econ topic, is influenced by capital, investment in equipment, technology that make labor more effective, usually technology, and these days artificial intelligence, efficiency, improvement in the organization, better processes, better management, production techniques, skill level, providing trainings and resources to workforce through education, through training. It will help. Innovation, implementing new ideas, methods, product, processes. It will help labor productivity. So by tracking this labor productivity over time, an organization and economist can make informed decision about investments, policies, strategies to improve economic performance. Whether they are working or not, we can measure labor productivity as an output of these investments. Let's take a look at this multiple choice question from Farhat Lectures. What does a high employee turnover typically indicate in an organization? So do we understand what high employee turnover is? It means people are leaving. There's the high rate of people being hired, then leaving, being hired and leaving. Is it high employee satisfaction? If people aren't happy, do they leave? The answer is no. Because of low employee satisfaction, people would leave. Effective management practices. If we have good management, what is that going to result into? Well, it's going to result into people staying because there's an effective management. People are happy. Therefore, B is out. Potential issues with workplace environment. Well, if there's any potential issues with workplace environment, people are not happy. They don't feel safe. They don't feel being included. They don't feel their opinion is taken into account. Well, these are toxic workplace environment, and as a result, people would leave, and as a result, will have high turnover employee. This is a good answer, but let's take a look at the lower recruitment cost. Not at all. High employee turnover usually indicate a higher recruitment cost because the more people leave, the more you have to hire. The more you have to hire, you have a hiring cost, training cost, onboarding cost, engaging cost, so on and so forth. You're going to have a higher recruitment cost, not a lower one. What should you do now? Go to Farhat Lectures, look at additional MCQs. That's going to help you do what? Understand this topic better. Whether you're a CPA candidate, studying for some other certification, or an accounting student, invest in yourself, invest in your career. It's worth it. Stay safe and good luck.